Hello, and welcome back to The Unlearned Investor. I'm your host, and this is the season premiere of Season 2, Investing with the Signal and the Noise. Episode 1, War in the Gulf and the Strait of Hormuz Blockade. Before we begin, the usual disclaimer: I am not a financial advisor. This podcast is for educational purposes only. Always do your own research and speak with a certified financial professional before making any investment decisions. Okay, let's get into it. As we navigate late May 2026, the geopolitical landscape has shifted from regional tension to an active global crisis. Following the opening salvos of Operation Epic Fury on February 28th, the world economy is now grappling with the brutal financial reality of a functional blockade in the Persian Gulf. For retail investors, the ensuing smoke requires moving past broad market fear to understand the structural signals dictating new global asset valuations. Our goal remains clear: we must use our brain to filter the structural reality hidden beneath immediate market noise and emotional panic. The current crisis traces its origins back to a seminal military event on February 28, 2026. Following months of escalating regional friction, coalition forces launched a rapid, symmetric military action labeled Operation Epic Fury. The objective was surgical. In a move that stunned global intelligence communities, the strike was successful, resulting in the death of Iran's supreme leader, Ali Khamenei. This decapitation strike immediately plunged the Middle East into an uncontained war, shattering decades of fragile regional deterrence. While global equity markets initially convulsed on the news, the true systemic economic devastation began during Iran's retaliatory phase. As symmetric military options failed to achieve strategic goals, Iranian command pivoted to asymmetric economic warfare. Exercising its powerful geography, Iran officially declared a security enforcement zone across the Strait of Hormuz on March 15, 2026. This move created a functional blockade of the world's most critical maritime choke point for energy transit. Using anti ship missiles, mines, and dual naval blockades, Iran successfully halted all regular merchant and energy traffic, despite massive coalition efforts to keep the channel open. The impact of closing a waterway that historically transits approximately 20% of the world's daily petroleum liquids cannot be overstated. According to official data from the United States Energy Information Administration, Hormuz is entirely indispensable. It serves as the main artery for energy traveling out of the Persian Gulf, and its prolonged closure has no viable physical alternative. None. The immediate visible signal of this supply shock is the price of energy. Brent crude oil, the global benchmark, advanced past all historic resistance levels. Driven by the complete physical constriction of Gulf supplies, Brent is trading toward $150 per barrel. This isn't just a number on a trading screen, it is a fundamental re rating of the baseline cost of modern life. If the fuel that moves global trade is 50% more expensive, the entire economic system feels the shock. A spike in energy prices does not exist in a vacuum. It triggers a guaranteed domino effect throughout the global economy, directly forcing inflation upward. Here is how it works: energy is the baseline cost of carry for almost all physical consumer goods. When oil hits 150, the diesel used by cargo ships and the trucks transporting food from the farm to the grocery store doubles in price. Furthermore, natural gas, the core raw material used to manufacture nitrogen fertilizers, skyrockets. The crisis is compounded by the fact that the five major exporting countries blockaded inside the Gulf historically account for over one third of the global trade in urea fertilizer. As outlined by the International Fertilizer Development Center, this severe disruption to global supply chains triggers immediate price volatility and resource hoarding. This means the cost of making and moving everything rises simultaneously. As we have previously analyzed, we are currently trapped in a regime of acute supply driven inflation. This is not the good kind of inflation caused by a booming economy. It is a stagflationary shock, where the rising cost of basic necessities, energy, and food begins to choke off all other economic activity. Food price inflation, expected to escalate heavily as fertilizer shortages impact global crop yields, will cement this regime. When war breaks out, the immediate emotional response of the market is to run for safety. Historically, gold is viewed as the definitive safe haven. We know that gold behaves like a non interest bearing currency utilized for the long term preservation of value. However, gold has already experienced a massive historic rally over the last year, pricing in significant systemic chaos. In late May 2026, retail investors are largely staying away from gold at these peaks, recognizing that the asset has limited upside benefit beyond this point and that the crisis premium is already fully priced into the shiny rock. Instead, capital is flocking heavily toward United States government bonds. We are seeing a structural flight to quality. In a modern supply shock, when global funding markets seize due to trade disruptions, international capital demands the liquidity of the United States dollar to settle debts and purchase essential commodities. The consequence of this flight to quality, combined with skyrocketing energy inflation, means that inflation will continue to rise and interest rates will be kept higher or even increased by federal banks. Central banks cannot lower rates while inflation is raging, completely ignoring political pressure and the lower interest rate environment that political figures like Donald Trump historically demand. Rates must remain restrictive to anchor expectations, which actively compresses broad equity valuations. High inflation forces a dramatic shift in behavior for both the government and individual investors. As we know, the Federal Reserve's primary mandate is price stability. To combat rising prices, they raise benchmark interest rates to deliberately cool demand. When interest rates rise, broad market valuations compress because the risk free return on government bonds looks far more attractive than the variable return on stocks. Here is the analytical filter you must apply. When interest rates rise, stock prices go down. This volatility is not a portfolio failure, it is a mechanical feature of high inflation regimes. This is exactly when good businesses come in cheaper, which is the time to grab. You must ignore the market gut, which is currently screaming to run and hide in cash, which is losing purchasing power daily to $150 oil. Instead, use your analytical brain to identify great businesses, those with mission critical moats, minimal debt, and most importantly, pricing power, which is the rare ability to raise prices to cover input costs without losing customers. When high interest rates cause a broad, indiscriminate market sell off, these quality businesses become available at deep value prices. While the conflict is terrifying, and there is arguably no historical asset class better than gold to strictly lock away real value during total systemic breakdown, other assets exist. United States government bonds are a functional alternative for capital preservation, but in an inflationary inferno, fixed income streams come with the inherent risk of purchasing power erosion. In a regime of prevailing high inflation, the most strategic asset a retail investor can hold right now is cash, but only as a tactical tool to wait. This is a market where capital is a weapon and it is optimized by waiting and watching. Use your brain to identify the great indispensable value producers on your watch list. Watch for temporary price dislocations in these strong moats, especially in consumer staples, which covers essential food, medicine, and hygiene. Things people are forced to buy regardless of the economic environment. Conversely, avoid the broader consumer goods sector where high inflation directly destroys the purchasing power of the average household. Lifestyle, luxury, and discretionary businesses will face an acute demand crisis as consumer wallets are eaten away by high energy bills and non essential consumption vanishes. By gathering tactical cash and watching the signal of quality businesses rather than the noise of wartime volatility, you can use the fortitude from your strong stomach to act decisively and invest when excellent businesses are irrationally dumped by the panic of others. If you've enjoyed this episode, please follow The Unlearned Investor on Spotify and subscribe on Substack at unlearnedinvestor.substack.com. See you and take care. Signing off, the unlearned investor.